With May drawing to a close, we focus in on the first week of June. Of course, that means the focus is on the jobs reports coming out of the US and of Canada. And of course, with the ups and downs of the conflict in Iran and the potential implications both on energy prices and inflation, that of course remains a key topic as we enter yet another month without the reopening of the Straits of Hormuz. So, kicking things off, we can see here that according to Trading Economics, the economic calendar, top tier events start like this: manufacturing PMI out of China on Monday, alongside the ISM manufacturing figure out of the US, where the expectation is that we see improvements in that reading up to 53. Then we see inflation heading things up on Tuesday, with the inflation rate coming out of the Eurozone. That expected to rise up to 3.4. No surprises there. The job openings figure out of the US provides the first of a handful of key data points for the employment picture in the US. And essentially, you're looking here at the potential for a decline once again in terms of job openings. GDP out of Australia and the ISM Services PMI out of the US on Wednesday. Then we've got the Australian trade data on Thursday, and we wrap things up with a focus on Canada and the US with the jobs reports and the IV PMI coming out of Canada. We've got to kick off, of course, with the US. And as we can see here on Monday, we've got the ISM manufacturing PMI, which is expected to increase up to 53, as we mentioned before. The job openings on Tuesday expected to decline. The ADP payrolls figure expected to decline. The services PMI figure expected to decline. We've got a theme here. Factory orders anticipated to rise up to 2.7% for the month. Initial jobless claim on Thursday. Then we've got the US jobs report, where the expectation is a headline NFP figure close to the 100K mark. The unemployment rate expected to rise up to 4.4%. The average hourly earnings expected to remain at 0.2%, and participation expected to decline down to 61.7. From a wider perspective, we can see this is what the jobs market currently looks like, this dashboard of some of the key metrics. You can see that whilst we have, of course, got a significant focus on a potential deterioration of the US economy, we haven't necessarily seen all that much really when it comes to the jobs report. Of course, we've seen some weak NFP figures, and you can allude to a number of different factors that have been driving that. But aside from that, we have seen a bit of a pickup in terms of the payrolls recently. Aside from that, you can look at that sort of unemployment rate. Yes, it's rising, has been rising. This time around, we're expected to see it gain ground once again, but really we're not seeing a significant rise for that metric. Many of these other metrics, yes, you can see a little bit of sort of concern where you're seeing, say, participation rate rolling over to an extent, the sort of quits rate flatlining there, the job openings sort of declining, but then sort of easing off a little bit now. And I would say, whilst we have seen many of these indicators trending, you can see that in actual fact, after the pandemic, we did see some major swings. And to an extent, there is a degree of normalization where the left-hand side of each of these charts look very similar to where we are at the moment after those major swings that we saw around just sort of 2020 and the following years after that. In terms of the US jobs report, notably, things have picked up somewhat. If you look at, say, 2025, many of the metrics were negative for one thing, but also many of them were simply seeing sort of one or two segments of the US economy providing the basis for growth, so above the zero line. In actual fact, of the last 4 months, we've actually seen 3 of them relatively strong, with a number of different sectors in the green. And so that makes a welcome change. It does provide the basis for people to say, well, the Federal Reserve don't necessarily have the job side of the equation as a sort of gauge of them needing to be more accommodative. That's why when you look at the latest minutes from the Federal Reserve, there was a feeling that they might have to move in the direction of tightening if we do see a really sharp rise in terms of inflation pressures in the US. And you could say, well, they're self-sufficient in terms of energy. We shouldn't necessarily see inflation to the same degree, but they still see many of the same prices as we see around the world, because essentially if there's a higher price abroad, it's likely that companies probably going to export their goods to be able to sell it at that higher price rather than charge a low price closer to home. So inflation does hit those that have it in abundance, just less so a case that they're hit by shortages and alike. So in terms of the market to watch here, I wanted to quickly jump on to the chart for gold. Now, gold, I think, is a really interesting one at the moment. We're actually seeing it pop at the moment as we see stories around a potential deal between the US and Iran, and that's certainly a key driver of everything at the moment. But certainly each time we see it rally, people say, look, told you I should have been long. And each time it starts to roll over, people say, look, I told you this is the end of the long-term bull run, and we're going to, we're just getting started, and we're going to see a big decline down to here. But ultimately, it's being quite heavily news driven at the moment. So we're regaining ground at the moment. Yes, we've breached through that first initial intraday swing high of 4462, but really we'd need to break through your 4580 mark before we start to point towards an end of this current downtrend that's in play. In terms of market expectations for Fed easing, we can see here in terms of the 2-year what the relationship's like. So essentially what should be the case is if we see the 2-year rise, then we should see the price of gold fall. That's typically the way that it works. So that is a reflection that if we see higher interest rates from the Federal Reserve, then it hinders support for gold. So if we invert it, then there should be a correlation between the two. So as you can see here, very closely correlated. So that means that if we see something that impacts the expectation around inflation, the expectation around the actions of the Federal Reserve, so it will have a tangible impact on expectations for the price of gold. And that's exactly what we're seeing here. So when we see stories about a breakthrough in terms of the US and Iran that might lead us to think there's going to be a reopening of the Straits of Hormuz, of course, that eases inflation expectations and inflation concerns. And therefore, we see upside in terms of gold. That's what we're seeing right now. Put into the context of this jobs report, of course, we've got to think, what would it take to shift the dial in terms of inflation expectations? Probably not going to see that. Maybe the wage figure, but that probably won't happen. On the other side of it, we've got the dual mandate of the Federal Reserve, means that if we see something that shifts the expectations around the health of the employment picture, then of course that does have a tangible impact. So if we would see higher unemployment, for instance, then you have a feeling that the Federal Reserve might have to start taking into account the health of the US jobs market and potentially ease rates. So higher unemployment or a weak payrolls figure could potentially drive the likes of gold higher, as we see the expectation of additional easing, or at least an easing in terms of the calls for higher interest rates. So like I said, we're rallying. We need to take out your initial swing high. I would say, look, every time we get good news to do with US and Iran, it's always the time where markets, rally and then it sells off. Every time we get bad news and we think we're on the cusp of a massive breakdown and the conflict once again, that's usually the point where the market reverses in the opposite direction. So I'm definitely pretty skeptical when it comes to that front. But certainly regaining ground at the moment, if we break the 45.80 mark, it gives us greater confidence that the bears are going to take a prolonged breather. But certainly as it stands, yes, we're regaining ground. But unless we break that level, then there is a good chance that we seem to roll over once again. But really, from a sort of US-Iran situation, there's a good chance that any breakthrough that we're seeing right now might not necessarily actually lead us into a position where we see an end to this war and we see a reopening of the Straits of Hormuz, because we've seen this story a million times before. Then let's jump on to Canada. Of course, Canada's an interesting one. The US-Canadian relationship from an economic perspective has absolutely collapsed thanks to Donald Trump. Their neighbors, no longer their best friends. In terms of the jobs report, what we can see here is that the expectation is that we're going to see the unemployment rate remain at 6.9%. The employment change figure back into positive territory, full-time employment positive territory, a decline in terms of part-time employment. That's not as much of a concern. The participation rate expected to rise, average hourly earnings expected to decline. And then the IVPMI, a sharp decline expected. What's notable here is that whilst we have seen, because of the whole Trump issue and the trade war between the two countries, we've seen a sharp rise in terms of Canadian unemployment. In actual fact, more recently, it's the Canadians that have been seeing unemployment declining. So that's a welcome sign. And in part, that's probably because of the fact that we're in a position where this war in Iran lifts the price of one of their major exports, and that is energy. So suddenly they've gone from a position of weakness to a position of strength, where they're seeing significant markups and margins in terms of their exports. Notably, the relationship between the Canadian dollar and the price of oil typically is a positive one. If we see higher oil prices, it generally lifts the value of the loonie, and that in no small part is because it lifts the value of their exports. Right, so there's greater demand for the Canadian dollar. Now, if you were to do the US dollar against the Canadian dollar, that relationship has by and large broken, and that's because the US is also a major exporter of oil as well. And we also see haven demand coming into play as well for the US dollar. So during this period where we're seeing strength in terms of oil, you might say, well, we should see that same kind of move coming into play with the Canadian dollar against the US dollar. But the US dollar also benefits from stronger oil prices, and it benefits from some of this haven demand. So I'm looking here in terms of the euro against the Canadian dollar. As you can see here, we have got this relationship where we are seeing a close tie. So where oil goes, we often see the EURCAD going as well. I'm just going to jump onto the chart itself, and we'll be able to see exactly how that's shaping up in terms of, say, price against Brent. Let's go. There we go. So if we invert the price of Brent, because of course at the moment we've got the euro at the beginning here, there's your relationship. So if we look at, say, the shorter term, exactly how that's playing out. So playing out very well. So it's, this is something I've been highlighting to you guys for a long time now. Throughout this crisis, a lot of time, what you're trading may not be what you think you're trading. You might just be trading oil, essentially, because these correlations are so prevalent at the moment. So, of course, the gains that we have been seeing in terms of oil from a wider perspective have driven the likes of the euro against the Canadian dollar lower, certainly here. Then we've seen some consolidation, and now we're sort of within this sort of phase. So it's almost like a symmetrical triangle. You've got the higher lows, you've got the lower highs. And so, if we break through the 1.615, it points towards a bullish breakup from here. But certainly if we do see the likes of oil turning higher once again, then we're looking at another rolling over here from this latest rally that we've seen in terms of EURCAD. The wider context does show you these lower highs in play. So a breakthrough 1.615 negates that, but certainly it does highlight the possibility that we do start to roll over from here. We're starting to weaken a bit here. Look out for your near-term swing low, which comes into play here, 1.606. If we start to break that, then from an intraday perspective, you have got this near-term trend starting to essentially falter, and it signals the possibility of a bearish turn from here. And finally, we of course have the issue of Iran. And quite frankly, this changes on a day-by-day basis. Right here, we've got some stories that I grabbed just before I made the video saying essentially the Iranians have targeted a US base. The US have called this an egregious ceasefire violation. Essentially, all of a sudden, it looks like we might be going back into a military conflict. But you fast forward, and about an hour later, these headlines start to come out that there's a potential breakthrough here. It's a 60-day ceasefire. It means that, you've got an MOU that's going to be signed, 60-day window where they can discuss the Iranian nuclear program. Crucially, the US Navy will lift its blockade, and the shipping through the Straits of Hormuz will be unrestricted. That is key here. We don't know if this is actually going to happen. Apparently, Trump hasn't approved it as it stands, and we don't know what the Iranians are saying. These are the kind of headlines that we've been seeing for a while now, but certainly when we're looking at the price for gold, that's exactly why we're seeing that pop for gold, because people suddenly think, oh my God, it's over, quickly jump onto gold. And then soon enough, it turns out to not be true, and then it rolls over. And that's why we're seeing, such a huge amount of news-based trading and news-based volatility at the moment. Of course, as we head into the new week, we still do remain in a position where the military conflict is over as it stands. It's still being held off. We do have the possibility of an agreement, but it just feels like both sides are in a position where they think they're winning. The US probably less so, but Trump doesn't want to be seen to show that he's essentially losing here. And so there's just this constant standoff. It doesn't really make for a position where we're suddenly going to see a breakthrough, but certainly, it's got to come at some point, you would think. You can see in terms of oil, there is an expectation that we are going to see a breakthrough. This is Brent crude. You can see that sort of 115 mark providing the top. Is this a big double top formation with the neckline here at 84? Potentially. I say look at this on an intraday basis because we're going to see a lot of this sort of volatility around news when it comes to the US-Iran issue. And therefore, when news breaks you out of your trend, then fair enough. And then you can look at things from an opposite perspective. But frankly, these news stories, whilst they do create volatility, and you can see some volatility here, that volatility is lessened as time goes on because we've seen the story a million times before. So nonetheless, we've seen that decline on the news. Then we've seen half of it regained immediately. So people are already starting to doubt it. And so, I just think more of the same, quite frankly. Look, until we see an actual signing of a deal and a real reopening of the Straits of Hormuz and loads of ships coming through, then we're just in the same position, quite frankly. And that means just look out for that intraday trend and follow that trend. That's what I think makes the most amount of sense. You can see when that trend has essentially broken because you look out for those swing lows. So you can see here, if we're looking at this trend here, you've got high highs, higher lows. When we see the breakdown, you could say this is the swing low. So you could say, oh, well, in actual fact, we haven't broken down through that low. But once you see those flatlining highs and then the breakdown through that neckline, then you've got your double top formation. And then we see the sharp sell-off. Soon enough, we start to regain ground, higher highs, higher lows for a while. We break through support, and then that set us onto a new trend. So as it stands, the bears are in charge. Of course, you have got that wider perspective of the potential double top, but that's still some way away from where we are at the moment. So I would say be careful. It's a volatile market. It's heavily news-based, but that sort of intraday trend trading does seem to be working relatively well as things stand. When we see the agreement that actually ends this, who knows when that's going to happen, quite frankly. There's going to be twists and turns throughout. But as it stands, this, for me, is a market that is essentially prime for manipulation, where Trump tries to talk down the value of oil, the Iranians try to talk it up. And a lot of the time we end the week pretty much in the same position as we started it. So, yeah, it's going to be the key theme once again. But it does give us plenty of opportunities when it comes to trading. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day and good luck trading. Thank you.